Welcome to the Bryan Foltice Behavioral Finance Podcast, where we unravel the mysteries of behavioral finance and unlock the secrets to making smarter, more informed decisions with your money. Now, here's your host, Dr. Bryan Foltice.
Hello and welcome back, everybody, to another episode of the Bryan Foltice Behavioral Finance Podcast. It is me, Bryan Foltice, and today we are going to dig into the topic of actively managed mutual funds, compare them to their alternatives, and then I'm going to do my best to leave the final decision to you and not to interfere or interject my own personal beliefs on your final outcome. Thank you very much for listening today. I hope everybody's doing well. I am trying to be in a better mood today. I don't want to sound so negative and critiquey. I was fired up in the morning. I had a lot of coffee when I was doing the previous episode and found a way to get very passionate about the topic of retirement withdrawal rates. If you've had me in class, you know that I definitely have a tendency of getting energetic and passionate. And you're finally starting to hear on the podcast a little bit of that. So I got a little involved about talking about Dave Ramsey's critique on this retirement withdrawal rate, and also trying to play the middleman, understanding that financial advisors aren't totally right either. And we concluded at the end of all of this that 4% is too conservative, 8% is a little bit too far out there, and if we have some flexibility in those numbers, I think we can find a sweet spot somewhere in the middle between those. Among the different, what would I call it? I guess it's the dialogue, or just the fact that I started paying a little bit more attention to what Dave Ramsey is teaching. After not really paying much attention for a large number of years, I'm not even sure if I think he has financial peace courses as well and tries to help people and has done an amazing job. So I do not want to discount. He's helped millions of people trying to get out of debt, getting out of debt. And this is one of the biggest strong suits that his impact has made on Americans and consumers around the world. And essentially, if I could package what he's sold for 30 years and made a billion, I think it's got to be $1 billion business at this point. It's everywhere. If you don't have money, don't spend it. If you have money, you can spend it. I think that's a pretty good way of staying out of debt. And he's really done an awesome job trying to build a community and a mindset around getting out of debt and then hopefully staying out of debt. Although that hasn't been my experience with when I would teach it. People would fall back into the same trap, buy his course again, and it's a pretty good business plan. I think a lot of people who have accumulated wealth after getting out of debt have sought out other resources. And when I start to hear about his bold proclamations about finding an advisor that will tout an 8% rule and makes assumptions on some of these returns, then it starts raising some red flags. And it kind of comes back to this conversation that I have in my behavioral finance class between active and passively managed funds. What's interesting is in behavioral finance, we talk about market efficiency and how behavioral finance has some questions around market efficiency. And we challenge these different levels, weak, semi-strong market efficiency levels. And we have a long list of different market anomalies that we've found and market phenomenons and consumer sentiment and consumer emotions and how it can sway some of these asset prices away from their fundamental prices. The question I always challenge my students with at the end of talking about all this is, what do you do with this information? And it's a dilemma that I've had to think about as well in my own investments, where I have papers out that are published in peer-reviewed journals that have shown we found excess returns in certain strategies, and using different metrics, we can squeak out a little bit of excess returns and maybe use some of these trading strategies. Maybe it works, maybe it doesn't. And just because we've proven it in the past does not guarantee or give you any indication that it will continue in the future. And so we see some of these phenomenons continue to persist. They continue on. Some of them go away or are deeply muted. And so you have all these different things going on. Does it continue? Does it not? And how do we do this? And so I sat down with Steve Dolvin, who's a co-author of mine, and he's always been usually a step ahead of me. If I have 17, 18 publications at this point, he's got 30, 40. And career-wise, he's what I always look to, and I always joke in my classes that you can call me the poor man's Dolvin in my classes. And anyway, he's been a great colleague, and I've sat down and talked to him about this when I was just getting started. And I said, Steve, okay, we've been writing papers on how to beat the market and different things. I said, how do you invest your money? And just left it, and he goes, oh, I'm index all the way. And I go, oh, good, me too. And that's all we said about it. We never talked about it again. We all concluded that we're index investors, and we are not going to pay for somebody to try to beat the market. So when we ask the question, are you trying to beat the market? That's active management. Or are you trying to be the market? That is index investing. That's also what we call passive investing for these funds. So obviously you know where I stand. I also realize that some people still believe in this active management, and I was surprised to hear that Dave Ramsey is still sticking to his guns on this topic, because most people who have done any research in the area of performance of mutual funds realize that there is strong evidence of no excess returns, or even at its limitation is, if you do find it, there's a huge survivorship bias in these funds. And again, just because there's a certain amount of funds that have outperformed in the past, how is that an indication that is going to do me any good trying to beat the market here in 2024? Furthermore, without that guarantee of trying to beat the market, this is just past performance, you want me to pay a front-end load? I thought those were gone with powdered wigs or dial-up back in the 1990s. I didn't even realize that mutual funds were doing front-loaded funds. And then also looking at the expenses for these funds, which are taken out and work against you as you're trying to build up your portfolio. Now, the one that he always liked to talk about in his programs and his shows, you could basically eliminate it down to one fund just based off of the assumptions that he made. There's only one fund, I think, still out there that was incepted in the 1930s and has had monster gains. Interestingly enough, I had my 15-year-old go in and grab the annual returns from 1934 to present day on this particular mutual fund. And I can see here that in 1934, this mutual fund outperformed the S&P 500 by nearly 27%. In 1935, it outperformed the S&P by 35%. And in 1936, outperformed the market by 11.9%. So right off the bat, you have three wonderful samples of outperformance here. Now, you can cherry pick the data and you can kind of look through it. But if I'm looking at this mutual fund, since I was born in 1980, I can see that it has underperformed the market by about 25 basis points. It looks like it has a little less risk, so that's speaking in favor of the mutual fund. But historically speaking, if we're looking at anything 1980 on, basically as things mature, become a little bit quicker, more efficient. Again, this is just a little bit of evidence. It kind of goes back and forth between if we're doing arithmetic returns or against geometric returns. A quick note about that as well. This actually does speak in the mutual fund's favor because it does have some smoother returns than the S&P 500. But the geometric return, and this is something that I want you to think about as consumers, as people, investment professionals tout or proclaim certain returns. We really want to delineate between, is that the average arithmetic return or the geometric return? Now, the importance around that is the arithmetic is the average number. That's how we learned about calculating returns in elementary school, junior high, high school. That means if the stock goes up by 50% and then goes down by 50% the next year, on average, we take all the data divided by the number of samples, and that's a 0% average. Well, in reality, what actually happens to our money over time is the geometric return. Because if I start with $1,000 and the market goes up 50%, I'm at $1,500. Now, if the market goes down the next year by 50%, I have $750, which means my geometric return is negative 25 divided by 2. And I think you add some exponential functions and it's around 12% or negative 12%. That's what's really happening to your money. That means if we're really looking at some of these returns, that's an important question to ask. Are you telling me this is a 12% average return or a 12% geometric return? And if you want to calculate that on your own, the way I usually do it in Excel is add 1 to each number. So every number has to be positive. And then the function in Excel that you use on the returns plus 1 are GEOMEAN, and then just grab the whole set of what you want to analyze, tick off 1 at the very end, and you'll have your geometric return. And that'll give you a more accurate picture of the actual returns, what your money will do or would have done in the past. Anyway, going back to the original premise of this actively managed fund, you can see that there's some evidence in favor of this actively managed fund. And then there's a lot of evidence, especially recently, around why would anybody feel convicted enough to do this, especially when you add in this front-loaded fund. Now, front-loaded funds or front-loaded fee is an actual percentage. And if you have $1 million, don't worry about it. You don't have to pay the front-loaded fund or fee anymore. If you have less than $25,000, you have to pay 5.75% just to get in. So that means if you're putting in $100, every $100 you put in, you get to invest the rest after the 5.75%. That means $94.25 get invested. There you go. This better be a really good fund that has some sort of super knowledge that I don't even know about in the financial markets. And then secondly, you have the expenses, where we compare these actively managed fund expenses compared to index funds. And once again, the good news is these fund expenses have come down considerably, I've noticed, in the past couple of decades. And they're trying to be more competitive. So even this fund was 58 basis points, so just over 0.5% per year. And if we compare that over time, all else equal, just to give you an idea of how this all works, if you had that front-loaded fund, and let's say we put in $100,000, $100,000, and that'll give us a discount down to 5.25% front load, and assume that both the active fund and the index return 12% over 30 years, how much of a difference do you think that is, all else equal? And let's assume that there are no expenses taken out for either one of these. Well, the difference that I get here after 30 years is you'll have, with an index, you'll have just under 3 million. And with the active, that front loaded will hurt you by $157,289. Once we think, hey, that's only $5.25 per $100. Well, over time, that's a big dent. Now, let's eliminate this front-loaded fund, because I thought we were done having this conversation, and really you have to have very strong conviction that this is a superhuman fund, and I'm still really surprised that this is still out there and that Dave Ramsey would still be talking about this over time, unless he's getting some money from them backdoor, and that's up to him and up to you as a consumer. But if I'm looking at this 0.58%, and like I said, I'm not talking about front end loaded. We're eliminating that. 0.58%. And let's give an index fund of 3 basis points. So 0.03% index fund. We're going to have 12% returns on both for 30 years, an initial investment of $100,000. For simplicity purposes, we won't touch that $100,000, so no additions, no withdrawals from that. Over 30 years, once again, you'll have just under 3 million with your index fund, and now we're at just over 2.5 million with the active portfolio managed fund. So you would think, on the surface, 55 basis points, 0.5% per year, not a big deal. That'll affect your final outcome by 0.5%. And the reality is, through compounding, it does not. In fact, you will have $408,148 less, or in terms of percentage, almost 16% less money with that higher percent expenses. If we made it a longer time period, my students, starting at the age of 22 for 40 years, this number becomes even greater. You have $9.2 million in your index portfolio. Your actively managed fund has $7.5 million, a difference of $1,645,000, almost 22% less just from expenses. And the trick is, there's an allure to some of these funds that have good track records. And also funds that have cool names. I've seen that happen. But at the end of the day, I don't know how to pick a mutual fund that would be the better, especially over time. Just because it happened in the past does not guarantee the future. So anyway, up to you. Just know that you were paying, that 0.5% that you were paying really needs to be made up in extraordinary returns. And if you're paying a front-loaded fee, you better have some ungodly conviction that this is a super fund, because I don't see any other reason that you would want to give almost 6% of your initial investment amount away to the investment company before they've gained any dollars for you. But I'm curious to hear what you have to say on this. Is there something that I'm missing? Any points of passion that I'm drawing out? But I'm honestly curious. So if you have any insights around this, I would love to hear from you. Please let me know, and would love to know how I might be able to educate or serve better. You can find me on bryanfoltice.com. Come and seek me out on Instagram, on LinkedIn, Bryan Foltice or Dr. Bryan Foltice, and would love to continue to have this conversation with you. Otherwise, thanks for listening today, and hope this was insightful, and have a wonderful day. I'll talk to you later. Bye.
Thank you for tuning in to another episode of the Bryan Foltice Behavioral Finance Podcast. We hope you found our exploration into the fascinating world of human behavior and finance both enlightening and thought-provoking. Be sure to subscribe for future episodes. And until next time, stay curious and financially savvy.